Would you still watch Netflix if there were ads in the middle of your favorite shows? I'm not sure I would, but it's a question that we're going to possibly be asking ourselves quite soon. This week, the share price of Netflix fell 40%. They are under pressure in terms of revenues, in terms of users. I'm joined by Guillaume Paillat this week, who's a fund manager on the multi-asset side. We're going to look at three key things. Number one, why is the share price falling so sharply with Netflix? Number two, why is this a broader story? Why are other tech companies really struggling this year? And finally, what does this mean for markets broadly, but in particular, the investment portfolios that Guillaume manages? Guillaume, let's start off with what's happened with Netflix. What's happened this week?
Yeah, so for the first time in more than a decade, Netflix announced that its number of subscribers actually declined. It was only 200,000 less subscriber in Q1, and they have 220 million, but they said they're expecting to lose potentially 2 million more in the coming quarter. And the investment case for those US growth companies was always about acquiring user first as opposed to generating profit. So that's what's getting the markets on edge at the moment.
Why have the subscribers fallen off?
Well, clearly the 80 days of the pandemics are behind us. We knew that tailwinds for those kinds of businesses would eventually fade as the economy reopens. But also, if you look at the streaming sector, we've got Amazon Prime, we've got HBO, Disney. I mean, you can't subscribe to everything. So there's a bit of saturation going on in the market. There's also other media that are competing for entertainment time. Look at YouTube, TikTok, video games. So yeah, I think that's really what's going on.
What are Netflix doing to combat this?
Well, it's interesting that they've announced that they're looking at clamping down on password sharing. As you know, Netflix is actually the most expensive streaming platform. So people often share passwords. So maybe there's a case to kind of generate a bit more user growth by clamping down on this. Also, they said that they considered introducing advertising, which was a bit of a change of strategy, given they always said they wouldn't do that, and potentially a way to lower the cost by introducing advertising.
Yeah, I'm not keen on that part. I'm not a fan of ads stuck in the middle of my favorite shows. So Guillaume, I mean, is this essentially that point about a growth story? I mean, it looks like the market was getting very excited back, during the pandemic, that there was this new virtual world. People will be staying at home. And we saw share price. I mean, I'm looking at my screen here and I'm looking at share prices in companies like Just Eat, Zoom, DocuSign, Peloton. These were names that had performed incredibly well over the last couple of years, down 35 to 40% year to date, all down 70 to 80% since their peak. Is this a story of the market just getting a little bit carried away and now coming back to start realizing that things are going back to normal and not everybody's staying at home?
Yeah, certainly. I mean, the sharp move that we've seen indicate investors were possibly too optimistic, expecting that lockdown behavior would continue. Also, at the time, investing in those tech stocks was all about capturing growth, which was scarce elsewhere during the pandemic. Now the environment has changed, and you've got growth which is more available in other sectors, and that's effectively, you can see that by the fact that interest rates are rising, which is a sign of economic growth effectively picking up, and that's definitely headwinds for those tech stocks.
Okay, so headwind of maybe some growth declining, but also that interest rate headwind for tech stocks. I mean, I hear this all the time. We hear interest rates are bad for tech companies, but I've never heard a really clear explanation as to why. So maybe I'll put you on the spot and ask you, can you in simple terms explain why interest rates are particularly bad for tech growth companies?
Sure, I can try that. Well, essentially, tech companies, they offer the promise of future profit. They may not make much money today, but they will eventually down the line. And when interest rates are zero, when growth is scarce, what else do you do with your money? You go and chase kind of those future growers. However, when interest rates start to go up, it's potentially less appealing for investor. There's more alternatives for investment, so they start to move their money elsewhere.
Okay, interesting. I think that is very clear, and that's exactly what we've seen. Okay, so Guillaume, maybe to finish up, what does this mean for markets broadly, and in particular for the portfolios that you manage?
Well, for equity markets, it's meant that the tech sector has lagged this year. You've seen the Nasdaq, the US tech index, is down 14% year to date, and also it's been quite painful for some of the funds that have been more exposed to that sort of tech trade. And there's lots of them around that had very good years in 2020, 2021, but really feeling the pain now. And for me, as we manage multi-asset funds, we strongly believe in diversification, because our customers are looking for a smoother journey. So while we have an exposure to tech, it doesn't really dominate the portfolio return. And actually right now we see better opportunities in other sectors. So we've been actually investing elsewhere.
Okay, excellent. Diversification. I know we talk about this all the time, but it really is coming to the fore. And as you said, there's some other providers that have suffered a little bit this year with a bit more of a tech bias. Guillaume, that was really clear as always, nice and short and to the point. Each week we put a portfolio manager on the spot. We ask them the difficult question. We try and bring that one big news story from the week. We will be back next week. We'd love you to join us again. Until then, take care.